Hello, everyone. Thank you for joining us today. This, of course, our quarterly market update, and the title for this particular webinar is Beyond the Panic, Investing with Clarity Post Liberation Day. Next slide, please. Now, of course, for any of you who ever participated in investment-oriented webinars, I have to quickly read you this disclaimer and just talk about a couple of admin things. So, of course, anything that we're about to discuss today should not be considered investment advice. The information we're about to share with you is entirely for educational, informational purposes only. If you actually decide to implement anything that we're about to discuss today, we strongly recommend that you do your due diligence, or of course you work with a qualified financial professional. This webinar will be recorded. The recording will be released after the webinar in our next newsletter. None of your information, your name, your email address, of course, will be in the recording, so you'll be perfectly fine from that perspective. We very much encourage you to ask questions as we discuss different things. And if your question is related to what we're discussing, we'll address it right away. You can type it up in the chat box, or there's a Q&A button that you should see in the bottom of the screen. So if you click on it, hopefully it will give you that option. We also have some questions that were submitted to us prior to this webinar that we will address. Next slide, please. Yeah, so in terms of the topic today, beyond the panic, investing with clarity after the Liberation Day. One thing I'll say for those of you who joined us, 3 months ago, in the middle of the market turbulence, well, think of this webinar as a follow-up to that. Essentially, hopefully you'll see how our thinking evolved since then over the past 3 months or so. Next slide. And what I usually do when we prepare for webinars like this, I look at the list of people who register, and we're actually expecting over 40 people today, which is great. And again, welcome everyone. We have two new clients who are new to Capital Squared. It's again great to have you with us. Now, for those of you who don't know us yet, my name is Alex Selesnev. I'm the founder and president of Capital Squared Financial. My business partner, Asa De Silva, he is our chief investment officer. In terms of our firm, we do different things, but we specifically focus on working with people who are thinking about transitioning already in retirement. So retirement and multi-generational planning is our specialty. In addition to providing individualized investment strategies, each client of ours has a specific investment policy in place. We're also very much focused on tax minimization, because for many people, again, who are thinking about or perhaps already in retirement, taxes is usually one of the main pain points. At this point, we work with over 70 families across the US. We actually have clients in 4 different countries. We manage over 150 million at this point, and we always serve as a fiduciary when we work with our clients. Essentially, any advice that we provide, it must be in your best interest. Of course, if you want to learn more, feel free to reach out to us or myself, or visit our website. Next slide, please. So again, and I know there's going to be people who joined us in the past. I usually try to start with a cartoon that is funny or perhaps not so funny, but something that resembles perhaps where we are at this point, or at least partially resembles that. So when we had a similar webinar, actually a year ago at this point, one of the quotes I used that you can see on the bottom of the screen by Sir John Templeton, who's actually one of the most famous value investors out there. The 4 most dangerous words in investing are, "This time it's different." And that just really appears to be the case. That was the case in April, again, 3 months ago, and we do have a sense that that is the case today. And what really amazes me when you think about investing, when you kind of look at it from this big picture perspective, how behavioral finance impacts our decisions, how quickly we can go from this panic state to this, overly excited condition and then perhaps back to it. And it's actually, it's a very well documented fact. Again, the behavioral finance, which started to become popular in early to mid 70s, when people normally act rationally under normal circumstances, but then when all of a sudden they're faced with uncertainty, that rationality tends to, in some sense, disappear. And that is, of course, something that, first of all, we need to be aware of. And in some cases, when an opportunity presents itself, perhaps it would be possible for us to take advantage of it. Next slide, please. Now, before we dive into different strategies, our outlook going forward, and I know Asi has a lot of good information to share with us, just to make sure everyone is on the same page in terms of the market conditions, because I don't know how much each of you follows the markets. So in terms of the year-to-date performance results, so the S&P 500 index, which is the most common index that is used, is up by 7%, which is actually pretty good. It's really good if you think about it. It was actually down by 19%, even more than that, intraday by mid-April. So that's quite a recovery since then. More tech-oriented, more growth-oriented NASDAQ index is up by essentially 10% at this point. It was down by as much as 23% by mid-April. So that kind of tells you the kind of recovery, again, we've been experiencing since then. Domestic small cap stocks are essentially flat for the year. These are more economically sensitive stocks, interest rate sensitive stocks, and we'll touch on that separately. Now, finally, developed international and emerging market stocks, they've certainly been adding to the diversification benefits and actually performance benefits. Again, for those of you who've been following the markets for a while, up until year 2025, most of those categories, used to really underperform domestic markets. So there's that light at the end of the tunnel, so to speak. Domestic bonds are up by 3% for the year, and there are very many different types of bonds. Here I'm just referring to the Barclays Aggregate Bond Index, which is perhaps one of the main indices for bonds. And Asi will talk about bonds separately today. In terms of the 10-year Treasury yields, which is important, would you keep track of that? For those of you who are less familiar, the 10-year Treasury, think of it as an input for many other rates, such as mortgage rates. And again, it impacts the markets a lot. We're at 4.44% at this point. I actually believe it came down somewhat over the past 24 hours or so. But again, given the turbulence in the bond market, actually in April, we're seeing more stability at this point. In terms of the sector performance, again, for those of you who are following, this is a bit more interesting than what it used to be over the past number of quarters, actually. For the first time in, I'm going to say, recent history, industrial stocks are actually leading the way. They're up by 15% for the year. And by the way, a lot of those stocks are defense stocks. So that has something to do perhaps with the new administration's agenda. Technology stocks, as I mentioned earlier, they recovered from the market sell-off in April. They're now up by 12% for the year. Utilities are up by 10%. And for those of you who pay attention to all of this, this is usually somewhat uncommon when you see technology and utility stocks performing at, somewhat of a similar level. But one of the reasons behind that is, of course, with artificial intelligence or AI requiring enormous amount of energy, perhaps even nuclear energy. That is one of the reasons why utilities are up this year. Energy is essentially flat. And when I say energy in this context, I'm referring to oil and gas. Today, we're not going to talk about the issues we had in the Middle East that lasted, 12 days. Not going to touch on that, but that essentially resulted in no particular impact on the sector. Consumer discretionary stocks, they're usually, leading the way when the markets are up, along with the technology stocks. They're in the negative by 2%. And perhaps the main reason behind that, there's this one, company that make electric cars with a very outspoken CEO that represents a pretty big chunk of this particular sector. That's why it's down, but many other companies in this sector are actually up. And then finally, healthcare, is in the bottom essentially by 4%, which perhaps is not that bad. And a lot of that, frankly, has to do again with the new administration's agenda, which perhaps we're not going to touch on much today. Next slide, please. So in terms of our key ideas for the second part of the year, this is again just to give you that big picture view, and later today Asi will go in much more detail here. So perhaps the biggest concern we have at this point, and I will say this is a concern of ours, is this perceived easing of uncertainty. And of course, for pretty much any of you who've been following, I'm referring to the tariff situation. See, back to April, specifically April 3rd and April 4th, post Liberation Day, the markets were down by almost 11%. I know it's easy to say in retrospect, but people clearly overreacted to that. Now, of course, the following week, April 9th, if I'm not mistaken, when the president decided to delay them for 90 days, the markets rallied. So we actually experienced one of the best, rallies in the history of the stock market. It was up by a little over 10% in 3 hours or so. The announcement was made in the afternoon. Now, since then, again, the market's pretty much fully recovered. And what becomes a concern of ours is anytime we hear of updates that perhaps are not that good, I mean, in terms of the tariffs, remains to be seen exactly what's going to happen on August 1st. But investors do not seem to pay much attention to that. There's this new term, TACO, that Asi is going to discuss later today. I don't want to spoil that piece for you, but that's again a concern of ours. Now, for the purposes of full disclosure, for those of you who are listening live or they're going to be listening to the recording, we fully rebalanced our managed accounts at the end of last year, so in December. We rebalanced them again prior to the inauguration day, so we're fully prepared for the April turbulence. When it was appropriate for us, we did buy stocks in April. Again, I don't want to say across the entire firm, but in certain more growth-oriented accounts. Earlier this month, specifically last week, we actually finished rebalancing our accounts, and essentially across the board, with some perhaps notable exclusions, we mostly took some gains off the table. Because from our perspective, again, the bargains are simply not there anymore. Rate cuts. So up until earlier last week, actually, the expectation was that perhaps we're going to see 2 of them later this year, 0.25% each. But as inflation begins to go up, that was actually surprising earlier this year when it was declining. At this point, the official number is at 2.7%. Remains to be seen what we're going to see throughout the summer, but perhaps we're going to see 1 or actually none. So remains to be seen. Perhaps on the positive side, at least for the stock market, the idea of deregulation is still there, and perhaps certain sectors would be impacted the most. Industrials, as an example, again, defense stocks, as an example, they're already leading the way. Energy, specifically when it comes to nuclear energy, and financials. And financials is something that we've been following quite closely on our end. The largest banks in the US, they're actually very heavily regulated. And, one argument is perhaps that's a good thing for the consumers, but then for the banks, and of course their shareholders, perhaps not so much. So if we see more of that deregulation, perhaps it's going to boost those particular sectors. Next slide, please. So in terms of our view, again, big picture view on the markets, the market participants or investors, they're overly pessimistic in April. And again, I understand it's easy to say for us at this point and, in retrospect. Now, where we are today, our view is that, the markets as a whole are overly optimistic about the future and perhaps even complacent. And again, back to the behavioral finance, issues that I discussed earlier, we kind of know what that leads to. It's just a matter of time before that sentiment changes and goes the other direction. So perhaps, again, this would be a good time to be a bit more cautious. Now, one of the concepts, and this one's been around for some time, so I can mention it. I don't think I'll be spoiling anything. It's called FOMO. It's that fear of missing out. And what happens, when the markets rally, people, of course, talk to each other in both, institutional and retail side, and they see certain companies or, again, certain sectors going up that much, and they just don't want to miss out. And as a result of that, they disregard some of the fundamental issues that in many cases are actually right there on the surface. So as I mentioned earlier, at this point, we just don't see that many bargains. In terms of the valuations, we're essentially back to where we were in the beginning of the year, the beginning of the first quarter of 2025. Now, I have to make this very clear so there's no misunderstanding. I came to this webinar and Alex told us to sell stocks. That is not what I'm saying. I'm not saying that you should be selling your stocks if you're comfortable with your investment mix, and let's say it's a growth-oriented one, and you can continue contributing, let's say periodically. Well, please continue to do that. That's perfectly fine. All I'm saying is, if someone wanted to take more risk, the time to do that was in April. Now is perhaps not the right time. So the bottom line from our perspective, at least, proceed with caution and keep that dry powder. One thing I'll say, and feel free to reach out to me 2 weeks down the road and provide some feedback, but we will find out, perhaps on August 1st or earlier, what's going to happen with the tariffs. Next slide, please. Now, again, taking this to a slightly different direction here, but to me, this part is very important because, as you can imagine, we had many conversations with our clients in April, of this year. So please take a moment and ask yourself, were you truly comfortable in April of this year, in April of 2025? Again, when the markets were down by 20% or so, perhaps your portfolio was down by 10%. If it was more aggressive, perhaps it was down by 30%. Now, if the answer is, I was not comfortable, that is actually perfectly fine. That is expected. If you tell me, what, I was comfortable about that situation, I'm not sure if I would believe you, when you say that. Now, what's more important, did you act on your emotions? And if the answer to that question is positive, meaning that you sold stocks when the markets are down, well, now would be the time to revisit your strategy. Why is now the right time? Well, again, the market's pretty much fully recovered with the exclusion of certain categories, but overall, again, we're back to where we were in the first quarter and even more than that. So if you want to revisit, this would be a good idea. When I say revisit, I actually mean it both ways. If you felt like you took too much risk in April, well, okay, well, perhaps this is a good time to make your portfolio more conservative or more income oriented. Or perhaps you felt like you were not prepared to buy stocks when the opportunity presented itself. Back to that dry powder idea. Again, this would be the time to prepare. Today, I'm not going to talk much about our approach. We refer to it as creating a fortress financial plan. This is certainly not the only approach out there to manage market turbulence, but it did work well. I will say that. Again, we have clients, usually close or in retirement, where we maintain at least 7 years of their reserves in bonds, right? So that gives you a pretty significant cushion. Usually anywhere between 70 to 80% or more of their cash needs, of their portfolio cash needs, are covered by income. So that gives you that extra comfort. And of course, after exceptional years such as 2023 and 2024, usually again, you have those additional reserves, right? Referred to as dry powder that can essentially be safely used in times of market turbulence to, yes, buy stocks at lower prices, very important, without endangering someone's financial plan, without endangering someone's, big picture, essentially. And with that, Asi, what do you have for us?